So you have over here a $5 million listed Oakville home and they sold for 4.6. But if you look into the back end that weekend, you can see that this property was bought for $5.6 million. They tried 6.5 in May from 2025 and they went all the way down and they eventually sold it after 6 months for 4.6 for over $1 million loss. Here's another example, and there's tons of these. And keep in mind, these aren't lenders that are power of selling the properties. These are actual sellers because they're under some kind of distress. So you have a property that sold for 730, but if you look all the way over here, these guys bought it for $1.2 million and they tried to sell this for 1.1 and they chased the market all the way down and they eventually sold this 6 months later for $730,000 for almost like a 40% loss. Here's another one. Property sold for $2.5 million. But when I look over here, you can see that they bought it at $3.2 million. They tried to lease it out to hold on to it and then eventually listed it for similar to what they bought it for, but then they chased the market down. This is what I'm saying. These are sellers who understand they have to sell it because of whatever reason, and they eventually found a buyer at a price where the market is willing to pay for. And this seller took a $700,000 loss. Here's another one in the condo space, $2.3 million. And when I look over here, they bought the property for $3.1 million. They listed for $3 million and they expect to take a loss, but they eventually chased the market down to 2.3 and they lost about $700,000 as well. Foreclosures are surging. Desperate sellers are being forced into fire sales in today's buyer's market. If you're planning to sell your home, this is the worst outcome to avoid. So in this episode, I'm going to show you what to do and what not to do so you can sell smart and protect your equity. So make sure you stick around until the end because I'm going to reveal the one mistake that's costing Toronto sellers the most money right now. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. Toronto area housing faces a wave of distressed sellers, and I am seeing this myself right now. So currently, according to this article, 3% of homes in Toronto are under power of sale, which basically means that the lender, could be a bank, could be a private lender, could be a B lender, whatever, has basically gotten possession of the property and they're now selling it to try to recoup their money. And 3% is a lot of listings right now. Now, we need to go and dig a little bit deeper to understand why a lot of these people are distressed sellers and just how distress are there, because I also have a lot of people who call me who are like, call it quote unquote salivating on trying to buy a property for like 50 cents on the dollar. And while that's possible, the likelihood isn't very high. Because when we look at the big six banks that are publishing their delinquency rate, RBC over here has a 0.42% in the Greater Toronto area where the mortgage is delinquent or 90 days past due. Now, you have to understand, 0.42 is 42 basis points or BPS, which is a fraction of 1%. And to understand in more relatable terms, it's 1 divided by 0.0042, which means 1 in 230 listings or so is under power of sale for RBC's metrics for now. So it's not 3% like this article was saying. But why is this article saying 3%? And I'm going to talk more about that a little bit afterwards. Because the important component here is that they're saying that this is a 7-fold increase in the last few years because there's been financial stress and the economy is bad and the housing market is very bad. Because when I look at my data that I have right now, you can see over here that RY represents RBC, and you can see it is about 0.42% of delinquencies. Now, I have data for other banks as well, which is over here. So CIBC, which is CM, is about 0.45, so very comparable to RBC. And BMO just came out with their latest report, and they say that right now, their residential mortgages are at about 0.32%, so even lower than RBC and BMO. Now, the other interesting tidbit that came from BMO's report is that over 30% of mortgages renewing in Q3 of 2025 are going to be experiencing a payment decrease, which means that their payments are going to go down. Or if I flip this around, 60%, if not more, of the mortgages renewing are going to get a payment increase. And this is what this exact article says. It just flips kind of the stat around to say that 2/3 of mortgage holders are now facing equal or higher payments. Before you even think about selling, don't let another chatbot price your biggest asset. Your property is not just another number. Hit the link in the description below and I'll send you a personalized assessment with real data and expert insights so you can sell with confidence on your terms. And when we talk about equity in Toronto, there's a lot of equity. So this chart right here shows you the average homeowner's equity, and it got as high as 80% in the 90s. And right now we have dropped to 74%. Or in layman's term, basically on average, every single home should only have 25% of mortgage on their property. But that's obviously not the case because 43% of homes in Toronto have zero mortgage. So it's the other 60% that actually have a larger mortgage, which is where we're seeing the kind of weaknesses on the edge and the fringe cases in the Toronto real estate market. You can see right now the average homeowner's equity is coming down because home values are coming down and they peaked in 2022 over here. And I'm providing you all of this delinquency data because everyone always likes to compare ourselves to how, oh, the Toronto real estate market is going to crash. And the technical definition of crashing is 20% drop. And we actually already had that. But a lot of people are trying to imagine that we're going to get that US level 2008 great financial crisis kind of crash. But I just don't think it's actually going to happen because when we look at the data for single family residential mortgages, at the peak of the great financial crisis, it was at 11.5%. And if most of the big banks, your prime borrowers, are at 0.5%, if I do 11.5% divided by 0.5%, we need power of sales and foreclosures to increase 23 times before we get to the delinquency rate that we saw in the great financial crisis in 2008. Now, here's the most important thing that I've been saying. There is actually a larger percentage of properties, assuming the status is correct, that are under power of sale. But if all the prime lenders are at 0.5%, how do we have 3%? And this is where we have to understand that a lot of times there are second position mortgages, private lenders who are forcing the owners to sell their property to recoup their cost. And if we use that 3% metric as power of sale, all we have to do is take 11.5% divide by 3. And all we need to see is that the private lenders, the B lenders, increase their power of sale by about almost 4 times. And then we can get a delinquency rate just for, call it your fringe cases, your B lenders, your private lenders, to actually be comparable to the great financial crisis. But your prime borrowers is a 23 times increase. So that's the big difference right now. It's your people who have taken excess leverage with second mortgages or have gone private lending or B lenders that are renewing and cannot service that debt anymore, where those lenders are taking possession of the property and selling it. But because in Ontario, when you do power of sale, you actually have to sell it for market price or show that you have. Otherwise, the person who owns the home that you're selling it on behalf of could sue you for damages. And this is why looking for power of sale deals isn't necessarily going to be great, but where I've always been saying is this: you should find the seller who is distressed but not gone to the power of sale position to actually get the best deal. And let me show you some examples where sellers have chased the market down because they wanted a higher price, but because they had to sell for whatever reason, they actually sold it for quite a large loss from what they originally bought it for. So you have over here a $5 million listed Oakville home and they sold for 4.6. But if you look into the back end that weekend, you can see that this property was bought for $5.6 million. They tried 6.5 in May from 2025 and they went all the way down and they eventually sold it after 6 months for 4.6 for over $1 million loss. Here's another example, and there's tons of these. And keep in mind, these aren't lenders that are power of selling the properties. These are actual sellers because they're under some kind of distress. So you have a property that sold for $730, but if you look all the way over here, these guys bought it for $1.2 million and they tried to sell this for 1.1 and they chased the market all the way down and they eventually sold this 6 months later for $730,000 for almost like a 40% loss. Here's another one. Property sold for $2.5 million. But when I look over here, you can see that they bought it at $3.2 million. They tried to lease it out to hold on to it and then eventually listed it for similar to what they bought it for, but then they chased the market down. And this is what I'm saying. These are sellers who understand they have to sell it because of whatever reason, and they eventually found a buyer at a price where the market is willing to pay for. And this seller took a $700,000 loss. Here's another one in the condo space, $2.3 million. And when I look over here, they bought the property for $3.1 million. They listed for $3 million and they expect to take a loss, but they eventually chased the market down to 2.3 and they lost about $700,000 as well. And the reason I'm showing you some of these examples is not because I'm trying to show you how bad the market is right now. That's actually not it at all. What I'm trying to show you is that there are fringe cases outside of the power of sale foreclosure listings that are actually losing more money than the power of sale just because of the way it works in Ontario with the recourse loan. And while yes, power of sales are increasing, they aren't at a large amount right now where we're going to have a systemic problem in the banking system because you can see over here, the main banks are at 0.5% of delinquencies. That's RBC. CIBC is at 0.5%. BMO is at 0.37 right now. And where you have these issues are your fringe cases with people that have overextended themselves that are not prime lenders. That's where a lot of the pain is right now. Not your prime lenders. It's the people who took on second mortgages, they overextended themselves, or they went to a B lender or a private lender and they can no longer service it. And even though power of sale in the description should in theory increase, this is not a good metric that I use to measure how bad the market is. This is more of a sentiment measurement for me, meaning how badly are people thinking about the property? Because at the end of the day, the buyers are willing to buy at a certain price point. So if the sellers meet that buyer's price point, there will be a sale. And that's why sellers right now are chasing the market down, and you need to price things accordingly based on the sentiment data for power of sale, because a lot of buyers are looking at this. They're like, well, I don't really want to buy it unless I know I'm getting a baked in deal with a little bit of cushioning in case the market falls more. Because one of the biggest mistakes I'm seeing right now, and I've warned a lot of people in previous videos, is that inventory was bound to spike again in September. So right now the month isn't over and we have 30,000 unsold properties already right now, which basically before the month is even over puts us at this inventory level right now. And remember how bad the spring market was, where there's no sales and tons of inventory, which is this chunk over here when we had more than 30,000 listings. We're already there right now. And this is why I kept harping on the fact that we're bound to get a ton of inventory increase in September in the fall market again. And this is the biggest mistake I see with a lot of sellers I talk about, where they're chasing the market down because they keep thinking the market's going to get better with these rate cuts. And yes, at some point they will make a difference. But when your inventory is at 30,000, it's not making a big enough dent for you to actually get the price you want. And you're going to be chasing the market down. And because in residential real estate, your property is worth what the last one on the street or in the building sold for, it's going to make your property worth less when your competition sells for less. Then the next buyer is going to want even less than that one because the market has 30,000 units right now. So it is actually very smart to cut your losses and be the first one to sell if you have a reason to sell. And if you don't need to exit the market right now and you can wait out another 3 years, 5 years, 7 years, who knows, until the market rebounds to get the price you want, then stay in the market. Don't sell right now. And if you're trying to sell a property and move into a different property, generally speaking, if you sell high, you buy high. If you sell low, you buy low. The only real difference is kind of at the margins, where if you're upsizing in a down market, the more expensive property you're upsizing to costs less nominally on like a dollar amount. And if you are downsizing in an upward market, your larger home that you're selling, you make more money selling it and you're buying a property that's smaller, but the increases are smaller. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. And this is why we have the saying, if you sell high, you buy high. And if you sell low, you buy low. And this is why if you're selling a property right now, it needs to be less than what the last comparable sold for, because you are going to find some distressed seller, whether power of sale or not, that is going to undercut you, set the new bar, and any future buyers are going to be expecting that lower price. So this is why I always say, the biggest determining factor of where prices are going to go is what the inventory is right now. And when we have 30,000 unsold listings and we're expecting to get more, there's a lot of pressure for prices to come down right now. So you don't have to look for power of sale to find a deal. You just got to find a seller who understands this and wants to get out of the market before it gets worse, because the sellers who are chasing the market down are more likely to lose money. And this is exactly why you're starting to see one-bedroom condos and studio condos for $350,000 in Toronto again. And this is exactly what I talk about in this video. So make sure to check that out. I'll see you then. Until next time, your move, your future. See ya.